What's up, guys? Welcome to the Cashcraft, your daily dose of finance and technology news and updates. In 1999, Amazon spent billions building warehouses nobody thought they needed. 25 years later, every retailer wishes they had. Right now, Amazon, Microsoft, and Google are making the same kind of bet, except this time it's on AI infrastructure. Their stock prices just took a beating because investors saw the spending numbers and panicked. But there's a pattern here that most people are missing, and it explains why some of these companies will dominate the next decade while others will fade into irrelevance. Bernard Golden has a framework for this. He calls it KGB, not the Russian spy agency, something that actually predicts which tech giants survive spending booms and which ones burn through cash for nothing. Here's what's happening right now. Big tech just reported earnings, and the AI capital expenditure numbers were staggering. We're talking hundreds of billions being poured into data centers, chips, and infrastructure. The market's immediate reaction? Sell. Amazon, Microsoft, and Google all saw their stocks drop because investors looked at those spending projections and saw risk. But Golden, who's the CEO of Navica and has watched these cycles play out for decades, sees something different. He's not asking whether the spending is too high. He's asking a better question. Which of these companies is spending in a way that actually builds lasting advantage? That's where KGB comes in. It stands for three things that separate smart infrastructure bets from expensive mistakes: keep, grow, build. And the order matters more than you think. Keep means protecting what you already have. If you're spending billions on AI, but your core business is under threat, you're not investing in the future. You're paying rent on the present. This is defensive spending dressed up as innovation. It looks the same on a balance sheet, but it creates zero new value. Grow means expanding an existing advantage. You've got something that works, something customers actually want, and you're scaling it before competitors can catch up. This is where the 1999 Amazon warehouse comparison gets interesting. They weren't building distribution centers to keep up with Barnes & Noble. They were building the infrastructure to become something Barnes & Noble couldn't touch. Build means creating entirely new markets. This is the riskiest category, but it's also where the asymmetric returns hide. You're spending money on something that doesn't have customers yet, might not have customers for years, but could reshape entire industries if it works. Now here's where it gets interesting. When Golden looks at the current AI spending boom, he's not seeing one category. He's seeing all three happening simultaneously, often within the same company. And most investors can't tell the difference. Microsoft's spending on AI infrastructure for Azure, that's mostly grow. They've got enterprise customers, they've got distribution, they're scaling an existing advantage. Google's AI investments? There's a lot of keep in there. They're defending search from AI-powered alternatives, which means they're spending billions to protect a revenue stream that already exists. Amazon's the fascinating one. Their AI spending splits across all three categories. Some of it's keep, making AWS competitive with Microsoft. Some of it's grow, expanding cloud services to more customers. And some of it's build, betting on entirely new applications nobody's figured out yet. What most people don't realize is that keep spending has a ceiling. You can't defend your way to dominance. You can pour infinite money into protecting what you have, and all you're doing is maintaining position while your margins compress. The market eventually figures this out, which is why those stock prices dropped. But grow spending and build spending work differently. Grow spending has compounding returns if you're actually ahead. Every dollar makes the gap wider. Build spending is binary. It either creates a new market or it doesn't. But when it works, you're not competing for share in an existing market. You own the new one. Here's the reframe that matters. The same spending number can mean completely different things depending on which category it falls into. A company spending $50 billion on keep is in trouble. A company spending $50 billion on grow might be unstoppable. And a company spending $50 billion on build is making a bet that won't resolve for years. The market right now is treating all AI infrastructure spending the same way. It sees big numbers, it sees compressed margins, and it sells. But Golden's framework suggests something different is happening. Some of these companies are building the next 20 years of competitive advantage. Others are just trying to survive the next 20 quarters. The question you should be asking yourself isn't whether AI spending is too high. It's which companies are spending to keep, which are spending to grow, and which are spending to build. Because 5 years from now, that distinction will be worth hundreds of billions in market cap. The companies that figured out the difference will look like Amazon in 2004, criticized for spending too much right before it became obvious they'd spent exactly enough. That's all for today, folks. If you found this helpful, make sure to like and subscribe to the Cashcraft for more finance and tech news. Drop a comment below with your thoughts, and I will see you in the next one.